So we're going to move to our next research session. And, Jeff, something you said about, the business of a community banker is not to eliminate risk, it's to mitigate risk. And so this is a nice segue because we're going to talk about credit risk, right? Which is just core for all banks. And obviously, we've got a couple interesting papers today. And I'd like to invite research panel number 3 to come to the front of the room. As we have in the other 2 research sessions from yesterday, we will hear from our academic moderator, George Pinocchi from the University of Illinois at Urbana-Champaign. We will hear from 3 presenters, and then at the conclusion of our presentations and response from our academic moderator, we will hear from our community bank discussant, Brenda Foster, President and CEO, First Western Bank and Trust, Minot, North Dakota. So with that, George, I'm going to turn it over to you to kick us off.
Okay, great. Thanks, Jim. So if you were here yesterday, you noted that the first research session focused on interest rate risk, the second one on environmental risk. So we're going to cover the bases today, and this session is going to cover credit risk. Our first paper is going to look at ratings by banks and examiners. And let me get the paper title right. Internal Loan Ratings, Supervision and Procyclical Leverage. And Stephen Karolyi from the Office of the Comptroller of the Currency is going to present.
Thank you, George. I'm looking for the clicker. Okay, perfect, thank you. Okay, great. Thanks so much, George. Thanks to Brenda for discussing all these papers as well. Thanks to the organizers for having our paper on the program. And can everyone hear me? Is this on? Okay, great, thank you. This paper is co-authored with 2 of my colleagues at the OCC, Louis Gall and Jonathan Jones, and our colleague at the Federal Reserve Board, Pinar Oysel. The views expressed here don't reflect those of the OCC, Treasury, or any U.S. federal agency, the Board of Governors, or the Federal Reserve System, and don't establish any supervisory policy requirements or expectations. Okay, and now that we've gotten that out of the way, we can move on. So this paper is making some points about internal loan ratings and linking internal loan rating supervision to procyclical leverage. So what is procyclical leverage? The literature has identified, and I think what seems to be true in the data, is that when asset growth is more positive, book leverage tends to increase. When asset growth is more negative, book leverage tends to decrease. Okay? And you might think that seems very intuitive. When the economy is expanding or when opportunities arise, we see banks levering up. But not necessarily true. Okay? If banks didn't adjust their balance sheets to changes in net worth that they observe, then leverage would actually fall, because when the assets and the equity rise by the same amount, the ratio of assets to equity will fall. So it's not actually a natural relationship if banks made no adjustments that we would see that positive relationship. But if there were more positive NPV projects in good times than bad, when asset growth is positive, then we should expect to see a positive relationship like that. The question is, and this is important for supervision, this is important for stability, is are these adjustments excessive? Is this positive relationship too positive? And the primary concern here is that if the leverage adjustments that banks make are too large relative to the increase in economic opportunities out there to expand the balance sheet, then this could feed back into credit and asset prices and amplify business cycles. Okay? There are many explanations that have been proposed for this positive relationship, and we're going to look into one aspect of this, one potential set of explanations. And we're going to start by looking at Basel II. So Basel II says banks should assess their risk weights and loan loss provisions which flow through to equity capital using internal risk ratings. And these internal risk ratings seem to be related to banks' incentives related to equity capital, related to profit. There are papers that have shown that among banks rating the same loan at the same time, those with lower equity capital will have more positive ratings, presumably to avoid provisioning against those loans and reducing equity capital further. And a problem with this is that when loan performance deteriorates, banks that were too lenient when making their initial risk assessments of the loan have to reconcile the deteriorating performance of the loan and the leniency that they had beforehand. So we see a steeper drop in ratings, too large of an increase in provisions, and even greater losses, even greater drops in equity than we would have observed if the banks were less lenient to begin with. Okay? So what are we going to do in this paper? We're going to do some complicated things and some very simple things. We're first going to ask the question, do banks seem to systematically inflate loan ratings? And this is different than papers that have looked at differences among banks rating the same loan at the same time. We're interested in whether, on average, the ratings are too high relative to the credit risk of the loans. So to do that, we're going to build a little model, and I'll provide some intuition for that model as we get there. But the idea is that there is a natural drift in ratings if ratings have forward-looking information. And if that drift is non-zero, then there's a systematic relationship. Okay? That systematic relationship shouldn't exist if the banks are anticipating future performance of the loans. Okay? And then we're going to look at whether that drift in ratings or ratings inflation at a point in time is related to characteristics of the loan that are known at the time of origination. And the idea here is that if there are characteristics of the borrower that the bank knows, or if there's information that the bank uses in pricing the loan at origination, if those characteristics predict whether the loan will subsequently have changes in ratings, then that means information that the bank has at the time they're making the loan is not being incorporated into the rating. Okay. And then the second part of the paper is really a linking supervision in here. We're going to study the Shared National Credit Program, which is a joint program of the OCC, the FDIC, and the Federal Reserve, in which we carry out loan level examinations. There's a mixed randomized targeted component to the assignment of exams to loans. And so we're going to exploit that to try to draw some inference about the effects of supervision on loan ratings. Okay? So basically what happens when examiners go in. Okay? We're going to look at spillover effects of those exams. So when an exam is assigned to a particular loan in a bank's portfolio, does the bank learn information from that exam and then apply it to other similar loans in their portfolio? In our paper, we're going to look at other loans that are from the same sector. Okay? And then the final piece of the paper is we're going to ask, okay, let's put these two things together. If supervision encourages banks to be more timely with their ratings, and more timely ratings are connected to capital through provisioning, then how different would the path of equity capital look if banks had more forward-looking ratings? Okay? Shutting down any differences in accounting treatments across banks, no matter what type of provisioning model they're using. Okay? So what we find in the paper, if I were to summarize in one sentence, it's that ratings inflation is very common. It's mitigated by supervision, and it contributes to the procyclicality of bank leverage. Okay? This is not intuition. This is math, and I was told not to talk about any math. So I'm basically going to skip over these slides. But what I wanted to just say is, our idea is that if there's drift in ratings that's systematic and can be anticipated at the time the loans are originated, that reflects. That indicates that the ratings were too high or too low at the time the loan was originated. Okay? So if we can predict confidently and systematically that loan ratings are just decreasing over time, that suggests they were too high to begin with. If they're increasing over time systematically all the time across all loans, then that indicates that they were too low to begin with. Okay? So that's the fundamental argument that we're going to make. The math is just there to say, how do we put this into a regression and then use data to estimate it. Okay. So those are the two pieces. I mentioned also that we're going to look at different characteristics that the bank knows about at the time they originate the loan, or information they might use in pricing the loan. And we'll show that those characteristics predict drift, or if they predict drift, they also explain ratings inflation at the time the loans originated. Okay? And what we're going to find is that that drift is explained by features that are related to the bank's incentives to inflate the ratings, and it's also related very much to the information used in pricing the loan. Okay, so we use information from this Shared National Credit Detailed Database. It's an administrative data set that the three agencies share. The idea is that it covers large loans that are shared by multiple lenders. These are complex credits, and the Shared National Credit Program has been supervising these loans since 1975. We're going to be complementing that with a few other databases. So what does the distribution of loans look like? Well, most loans are pass rated. That's encouraging. Banks are not originating lots of doubtful loans. So between 86 and 87% of loans have a pass rating. Under 5% have a special mention rating, and all the way down the line from substandard, doubtful, and all the way to loss. These are the classified ratings. A pass rating is a loan that's in good standing. A loss rating is uncollectible. So there's a range of ratings. These are the 5 groups that we have that we observe in the database. Okay. I want to tell you about just how large this drift is. So we're going to estimate this drift using a whole bunch of different regression models. What we call fixed effects are just characteristics that we think are generic and might explain variation in the drift. So what factors seem to explain this drift over time, or ratings inflation at the time of origination? And a lot of what's interesting is that there are some borrower factors that matter, which could reflect like a general trajectory of a borrower. But the lender factors matter a lot, particularly lender factors when they're interacted with the sector of the borrower or time, which suggests that something about the lender is influencing ratings drift. Okay? And in terms of the magnitude of the drift, we estimate this coefficient on ratings, it's 0.07. What does 0.07 mean? Well, if we think about, remember, between 86 and 87% of loans have a pass rating. The other ratings account for about 14% of loans. So 0.07 suggests that on an annual basis, about 50% of 50% more loans would have a non-pass rating per year when we have a 0.07 coefficient, just because of that drift. Okay, so it's a relatively significant estimate, this 0.07. So what do we find? What are the characteristics? Well, larger exposures translate into larger provisions, and we find more ratings inflation when the exposures are large, particularly the utilized fraction of the loan. And we find lots of characteristics that are related to risk of the borrower at origination explain drift. And we find one interesting one is that almost a monotonic relationship between the interest rate spread at origination and subsequent drift. So the riskier borrowers that we know are risky because the loan has a high interest rate have higher drift. Okay, so that suggests that the information used in screening and pricing the loans is not incorporated into the ratings, especially when the banks have a high exposure to the credit. Okay, so the second part of the paper is about this Shared National Credit Program exams. So we're going to exploit this structure. There are exams where the SNCC program office randomly selects some exams, conditional on characteristics of the loan. And then there are some where they target, and they explain how they target these loans in the annual report that they release on their findings from the Shared National Credit exams. And so these could be different characteristics of the borrower or the loan that they're going to select on. So they want to really emphasize a particular sector in a given year or loans of a certain type. And so those loans will be targeted. They're not randomized, and the other ones are going to be randomized. Randomized loans are called reads. The loan is read when it is examined. Loans that are targeted are called mandatory reads, and so we're going to just call those mandatory exams. What we want to understand is, what is the impact of the loan being read on the change in ratings during the period in which the loan is examined. And so, so what do we observe? During the during a SNC exam, the bank will submit their internal ratings. Then there will be 2 examiners, one from each of the 2 of the 3 agencies that are examining the loans will be assigned. They will go in and collect information about the loan and evaluate the accuracy of the bank's ratings. Then supervisory ratings will be assigned at the end of the exam. Okay? So we observe in our data both the bank's internal the submissions of the internal ratings, as well as any adjustments that happen after the exam between that and the supervisory ratings. In cases where the 2 examiners disagree, a 3rd examiner from the 3rd agency is assigned to break the tie when they're constructing those supervisory ratings. So this table shows you the effect of the loan being read on the change in ratings. Okay? And if you remember, the higher ratings are loss ratings, the lower ratings are pass ratings. So a positive coefficient means we're moving from pass ratings to loss ratings. So we find that when a loan is read, there's a 40% increase in the timeliness of those loans. The change in ratings is 0.046 higher than it would have been otherwise. And that relative to a normal drift of 0.07 that we saw on average. And so that's a significant increase in the likelihood that the loan is downgraded. The ones that are selected for mandatory exams, those are based on whatever criteria the SNC program office uses to evaluate how to assign those exams. And so we find that those loans, the loans that are targeted by the SNC program office, have less timely ratings. Okay, so that's what that negative coefficient means there. We do some interesting tests where we actually focus in on what the change in ratings that occurs during the exam period and the change in ratings that occurs between the last exam and the bank's submission of their internal ratings. And we do that because there should be no effect of the exams on the change in ratings from last supervisory rating to the bank's internal submission, because the bank doesn't anticipate or know which loans are going to be randomly selected for the exam. So this is something we'd call a falsification test. And we find exactly no effect in that case. And we find all of the selection effect, the SNC program office selecting the loans for the mandatory reads, is isolated in this part of the change in ratings, the part between the last rating and the bank's internal submission. If we look just at the piece that happens during the exam, we find a similar effect of exams on both those that are selected and those that are randomly selected. So that suggests that expanding the program or changing the size of the program, doing more exams, would have similar impacts. Okay, as I said, I'm not going to have time to tell you about the interesting counterfactuals about what would happen to equity in different cases, so I'll just leave you with this. What we find in the paper is that ratings inflation is really systematic. It happens all over the bank's portfolios, across banks. It's predictable based on characteristics that the bank knows at origination. Supervision seems to mitigate some of this ratings inflation and makes ratings more timely. More timely ratings would reduce the procyclicality of leverage. Okay, thanks very much.
Thank you, Stephen.